Most traders think making money requires being smarter than the market, having perfect entries, or developing some genius-level intuition. That's backward. After making over $1,600 on a single trade using nothing but basic math, let me tell you what nobody wants to hear. You don't need to be smart to win consistently. You need to be willing to be average in a very specific way. Think about it. If someone offered you door A with a coin flip chance at $1 million, or door B with a 50.1% probability, which would you pick? Everyone picks door B. Not because it's exciting, not because it feels right, but because the number is objective. That's the entire game. While everyone's hunting for the perfect pattern or the secret indicator, profitable traders are just doing basic arithmetic, finding anything above a 50-50 shot and executing it the same way every single time. No heroics, no brilliance, just respecting what the numbers say happens more than it doesn't. By the end of this video, you'll understand why being a mediocre executor with good math beats being a genius with no system, and why your inconsistency has nothing to do with intelligence and everything to do with fighting probability instead of riding it. Welcome to Trader's Bible, the quiet room for market mastery. Let's get into it. Here's what most people don't understand about trading. The problem isn't that you don't know enough. The problem is that you're trying to be impressive when you should be trying to be boring. Let me explain what I mean. When you opened a trade this morning, what were you thinking? If you're honest, you were probably thinking something like, this setup looks clean, or I have a good feeling about this one, or the momentum is strong here. And that's exactly why you're inconsistent. Because none of those thoughts are anchored to anything objective. They're just your brain trying to make sense of chaos by creating a narrative that feels comfortable. But here's the thing about comfort. It's the exact opposite of what you need. You don't need to feel good about a trade. You need to feel indifferent. And the only way to feel indifferent is to have a number that removes the emotional weight from the decision entirely. Think back to that door example from the intro. Door A gives you a coin flip. Door B gives you 50.1%. The difference between those two doors is 0.1%. That's it. Not 50%. Not even 5%. 0.1%. And yet, every single person picks door B without hesitation. Why? Because the moment you have an objective probability, even a razor-thin one, your brain stops doing the work. You stop trying to feel your way through the decision. You just execute based on the number. That's the entire game of trading distilled into one principle. Find anything above 50-50 and execute it the same way every single time. Not when it feels right. Not when the setup looks perfect. Every single time. The number tells you it's worth taking. Now, I know what you're thinking. You're thinking, Trader's Bible, I already have a strategy. I already know my setups. The problem is I hesitate when they show up or I close them too early when I'm in drawdown. And you're absolutely right. That is the problem. But the reason you have that problem isn't because you lack discipline. It's because your strategy isn't actually built on objective probabilities. It's built on discretion disguised as a system. Let me show you what I mean. Most traders will say something like, I trade breakouts above key levels. Okay, great. But what's the probability of that breakout continuing versus reversing? Well, it depends on the context. No, that's discretion. That's you making a judgment call in the moment based on how the chart feels to you. And the second you introduce feelings into the equation, you've opened the door for every psychological demon you have to walk right in and sabotage the trade. Hesitation shows up because you don't actually know if the edge is real. Overmanagement shows up because you don't trust the target. Closing too early shows up because you're scared of a red number turning into a bigger red number. All of these behaviors are just symptoms of the same root problem. You don't have an objective number telling you that this specific action in this specific context has happened more than it hasn't over a quantifiable sample size. So let's fix that. Let's talk about how to actually build a system where the number does the heavy lifting for you. The first thing you need to understand is that statistics in trading are not predictive tools. This is where most people go wrong. They see a statistic like, the market retraces to midnight, open 62.3% of the time between 8 a.m. and noon, and they think that means, oh, so if I just buy every dip toward midnight open, I'll win 62% of my trades. Wrong. Dead wrong. That statistic doesn't predict what will happen today. It just tells you that if you were to run this same scenario 100 times, roughly 62 of those times would see a retracement to that level. But here's the problem. You're not trading 100 scenarios. You're trading one today, right now. And today might be one of the 38 times it doesn't happen. So how do you know which side of the coin you're on? This is where live price comes in. And this is the part that nobody talks about because it's not sexy. It's not a secret indicator. It's not a hidden pattern. It's just watching how price behaves in real time and using that behavior to tell you whether the statistic is likely to play out or not. Let me give you a concrete example. Let's say you know that between 8 a.m. and noon, there's a 65% probability that the market retraces to midnight open. Great. That's your statistical edge. That's your door B. But then the market opens at 9:30, and instead of accepting prices above the opening range, we immediately close below it. Price is rejecting higher. We're accepting lower prices. The auction is saying, no, we don't want to bid this higher. Now, does that mean the statistic is invalid? No. It just means that today might be one of the 35% of days where it doesn't play out. And the beautiful thing about having that statistic is that it gives you permission to not take the trade. You're not missing out. You're not being a coward. You're just recognizing that the live price component is disagreeing with the statistical edge, so the probability has shifted against you. On the flip side, let's say we open at 9:30 and we immediately start accepting above the opening range. We're making higher lows. We're respecting support. The auction is saying, yes, we want to bid this higher. Now your statistic and your live price are aligned. That's when you execute. Not because it feels good. Not because the setup looks clean. But because the objective probability and the real-time behavior are both pointing in the same direction. This is what I mean by being a mediocre executor with good math. You're not trying to be a genius who calls every turn. You're just following a simple rule. If the statistic says above 50-50 and live price agrees, take the trade. If either one is missing, don't. That's it. That's the whole system. But here's where it gets interesting. Because once you have that foundation, you can start layering in additional data points that increase the edge even further. And this is where most traders actually start to see consistency. One of the concepts I use religiously is something I call the P12. The P12 is just the first 12 hours of the daily candle. I cut the daily candle in half, and I look at how price is interacting with the midpoint, the high, and the low of that first 12 hours. Why? Because if you think about it logically, the second half of the day is going to print relative to the first half. If the first half of the day established a bullish structure, higher highs, higher lows, excepting above the mid, then the second half is more likely to continue that structure. If the first half established a bearish structure, the opposite is true. This is what I mean when I say you're not trading a trend. You're trading the wiggle of a daily candle. You're not trying to predict where the market is going next week. You're just trying to figure out how this candle is going to close today based on how it's already printed in the first half. And when you narrow the scope of the problem like that, it becomes so much easier to execute. Because you're not asking, is the market bullish or bearish? You're asking, is the second half of this candle likely to print above or below the mid of the first half? That's a much simpler question. And it's a question you can answer with data. If you're getting value from this breakdown, do me a favor. Hit that subscribe button and turn on notifications so you don't miss the next one. I'm dropping these statistical frameworks every week, and I promise you, this is the kind of content that'll actually move the needle on your consistency. Drop a like if this is clicking for you so far. All right, let's keep going. Now let's talk about targets, because this is where most traders completely fall apart. They'll do all the work to find a good edge, they'll execute the entry perfectly, and then they'll absolutely butcher the exit because they don't have a statistical framework for managing the position. Here's what usually happens. Trader takes a short, trade goes 5 points in their favor, they're up $50. Unrealized profit. They start thinking, okay, this is great, but what if it reverses? What if I give this back? So they close it. Then they watch the trade go another 30 points without them, and they're furious. I knew I should have held it. I'm such an idiot. Or the opposite happens. Trade goes 5 points against them. They're down $50. They start thinking, okay, it's just a small drawdown. It'll come back. So they hold it. Then it goes another 20 points against them, and they panic close at the worst possible spot. Either way, they're managing the trade based on emotions, not probabilities. So here's the fix. You need to know, before you even enter the trade, what the statistical checkpoints are. Not where you think price might go, not where you hope it goes. Where does price statistically have a high probability of reaching based on historical data? For example, in my system, I know that when we break below the 930 opening range, there's roughly a 70 to 80% chance that we reach 0.1 to 0.3% away from that break within the first hour. That's not a prediction. That's just what the data says happens most of the time. So that becomes my first target. That's where I pay myself. Notice I didn't say, that's where I close the entire position. I said, that's where I pay myself. Because here's the thing. If there's a 70 to 80% chance of hitting that first target, that means there's a 20 to 30% chance it doesn't. So I'm taking some profit off at that first checkpoint to make sure the trade is cash flow positive, even if it reverses. But I'm leaving a runner on because occasionally we get those extended moves that go way beyond the statistical expectation. And this is what I mean by scaling out at high strike rate zones. You're not trying to hit a home run every time. You're just trying to consistently hit singles and doubles, and every once in a while, you'll get a triple or a home run without even trying because you let a piece of the trade run. And here's the beautiful part. When you manage trades this way, You completely eliminate the overmanagement problem because you're not watching unrealized profit and freaking out. You already took profit at the high probability zone. Everything beyond that is just house money. If it works, great. If it doesn't, you're still profitable on the trade. Same thing with drawdown. If the trade goes against you before it hits that first checkpoint, you know objectively that the statistical edge has failed. It's not working. And that's okay. Because you also know, based on your data, that this happens roughly 20 to 30% of the time, so it's not a surprise, it's not a failure, it's just an expense. And this is where the mindset shift really matters. Because most traders view losses as personal failures. I took a bad trade. I'm a bad trader. I need to be better. No. You took a trade that had a 70% chance of working, and it fell into the 30% that didn't. That's not a failure. That's probability. Think about it like owning a rental property. Every few years, you're going to need to replace the roof. Or the HVAC system is going to break, and you'll need to fix it. Does that mean you're a bad property owner? No. It just means things break. That's the cost of doing business. You budget for it. You expect it. And when it happens, you don't freak out. You just fix it and move on. Trading is the same way. Losses are just the cost of doing business. They're the new roof of your trading system. And when you can quantify how often they happen, my strategy typically fails 1 or 2 times per week at the cash flow level. You can actually budget for them. You can say, okay, my max risk per trade is X, and I know I'll have 1 to 2 losses per week, so my weekly risk exposure is Y. Now you're managing the downside like a business instead of reacting to it like a gambler. But here's where it gets even more interesting. Because once you have this statistical framework in place, you can start to identify sequences that tell you when to hold and when to fold. One of my favorite concepts is something I call the 3-hour line. If the idea is simple, after the 9:30 opening range is established and we break out of it, the market is going to do one of 2 things. It's either going to trend cleanly in that direction for the next 3 hours, or it's going to fake the move and then chop around or reverse. Now, if we're trending, there's a specific sequence that has to happen. Let's say we break below 9:30 at 9:45. If we're truly trending lower, then the 10 o'clock hour should take out the low of the 9 o'clock hour, and then the 11 o'clock hour should take out the low of the 10 o'clock hour. It's a logical sequence. If you told me the market is going to trend down for 3 hours, I would expect each subsequent hour to make a lower low. That's just common sense. So here's how I use this. If I'm holding a runner and we're in that trending sequence, I hold. I don't touch it. I let it breathe. But the second that sequence breaks, let's say we're in the 11 o'clock hour and we fail to take out the 10 o'clock low. I know the statistical edge is gone. The trend is broken, and I close the runner immediately. This is what I mean by letting the numbers tell you when you're wrong. You're not guessing. You're not hoping. You're just following the sequence, and when the sequence breaks, you exit. No emotion. No second guessing. Just execution based on what the data is telling you in real time. Now let's zoom out for a second and talk about what this actually looks like in practice. Because I know some of you are thinking, this sounds great in theory, but how do I actually implement this? And the answer is simpler than you think. First, you need to pick a time-based anchor. For me, it's midnight open and the 9:30 RTH open. For you, it might be something else. It doesn't matter what it is as long as it's consistent and you can quantify probabilities around it. Second, you need to build a database. I know that sounds boring, but this is the work. You need to go back and measure how often certain things happen. How often does the market retrace to midnight open between 8 and noon? How often does a break below 9:30 lead to a 0.1 to 0.3% move within the first hour? These are the numbers that give you confidence. Third, you need a live price filter. For me, it's the P12 and the 930 range. If live price is aligning with my statistical edge, I execute. If it's not, I don't. Simple. And fourth, you need to know your checkpoints. Where are you taking profit? Where are you exiting if the edge fails? What sequence needs to happen for you to hold a runner? All of this needs to be defined before you enter the trade. When you have all 4 of those pieces in place, something magical happens. You stop caring about individual trades, because you know that over a large enough sample size, the probabilities will play out. Some trades will hit all your targets. Some will stop out before the first checkpoint. Most will land somewhere in the middle, and that's okay, because you're not trying to win every trade. You're just trying to execute the same process over and over again, and let the math do its thing. This is what separates consistent traders from inconsistent ones. Consistent traders have a system that removes discretion. They're not smarter. They're not better at reading price. They're just better at following a process that's anchored to objective probabilities. And over time, that compounds into real sustainable edge. So here's the question you need to ask yourself. Are you trading probabilities, or are you trading feelings? Because if you're still hesitating on setups, if you're still closing trades too early out of fear, if you're still over-managing positions because you don't trust the target, you're trading feelings. And feelings will never, ever give you consistency. But if you can shift your focus from being smart to being objective, if you can build a system where the numbers tell you when to execute and when to exit, if you can treat losses like business expenses instead of personal failures, that's when everything changes. That's when you go from being a gambler hoping for a good day to a trader running a business that prints profit consistently. And here's the kicker. This doesn't require genius. It doesn't require some special talent. It just requires the willingness to do the boring work of quantifying your edge and then executing it the same way every single time. No heroics, no brilliance. Just respecting what the numbers say happens more than it doesn't. Now you might be wondering, what happens when the numbers stop working? What happens when your 65% edge starts dropping to 55%? Or even 50%? Does that mean the system is broken? Not necessarily. And understanding why is going to completely change how you approach drawdown periods. But before we get there, you need to understand something most traders never figure out. Most traders never figure out the difference between a broken system and normal statistical variance. See, this is where people lose their minds. They'll have a strategy that works beautifully for 2 months straight, and then they hit a week where they go 0 for 3, 1 for 4, maybe even 0 for 5. And immediately they panic. The edge is gone, the market changed, my system doesn't work anymore. So they abandon it and go searching for the next thing, the next indicator, the next pattern, the next guru telling them about some secret setup. But here's what's actually happening. They're experiencing normal variance. And they don't know the difference because they never built a statistical baseline in the first place. Let me explain what I mean. If you have a trade setup that hits its first target 70% of the time, that doesn't mean it's going to hit 7 out of every 10 trades in perfect order. It doesn't mean you'll never see 3 losers in a row. It just means that over a large enough sample size, let's say 100 trades, roughly 70 of them will work and 30 of them won't. But those 30 losers, they're not going to be evenly distributed. Sometimes you'll hit 5 winners in a row. Sometimes you'll hit 3 losers in a row. That's not the system breaking. That's just how probability works. Yeah, it's the same reason you can flip a coin 100 times and get heads 7 times in a row, even though the true probability is 50-50. Variance exists. Streaks exist. And if you don't understand this, you'll mistake normal variance for a broken edge, and you'll blow up perfectly good strategies. So how do you tell the difference? You track your numbers like a business. You don't just look at your win rate week to week. You look at rolling averages. You look at quarterly performance. You look at whether your actual results are falling within the expected range of variance for your stated edge. For example, if my cash flow target has a 75% hit rate over 100 trades, I should expect to see roughly 15 to 25 failures in that sample. If I'm at trade number 40 and I've already had 15 failures, that doesn't mean the system is broken. That just means I'm on the higher end of expected variance. But if I get to trade number 80 and I've had 40 failures, now we have a problem. Now the data is telling me something has fundamentally changed and I need to investigate. This is what I mean by treating trading like a business. A business owner doesn't freak out because they had one bad week. They look at trends. They look at whether their key performance indicators are still within acceptable ranges. And they only make changes when the data definitively shows that something is off. The same applies here. If your edge is statistically sound, you should expect variance. You should expect losing streaks. And you should have defined thresholds for when you'll investigate versus when you'll just keep executing. Yeah, because here's the brutal truth. Most traders aren't failing because their system is broken. They're failing because they keep abandoning systems during normal drawdown periods before the probabilities have a chance to play out. Think about it like this. If I told you that you're going to flip a coin 100 times, and I'll pay you $2 every time it lands on heads, but you pay me $1 every time it lands on tails, would you take that deal? Of course you would. Because even though you're going to lose roughly 50 times, you're going to win roughly 50 times and the payout structure favors you 2-to-1. You'll walk away with $50. But here's the thing. What if the first 10 flips are all tails? You're down $10. Are you going to quit? No, because you understand the math. You know that over 100 flips, the probabilities will normalize. You're not quitting at flip number 10 just because you hit a bad streak. But that's exactly what traders do. They hit 3 losers in a row and they panic. They abandon the system. They go searching for something else. And they never give the probabilities time to work. Now let me be clear. I'm not saying you should blindly follow a system that's clearly broken. If your edge is deteriorating over a statistically significant sample size, you need to adapt. But the key word there is statistically significant. Not 3 trades, not 5 trades, not even 10 trades. You need enough data to know whether you're experiencing normal variance or actual edge decay. And this is where having a database becomes invaluable. Because when you've tracked your edge over hundreds of trades, you know what normal looks like. You know what your worst losing streak has been historically. You know what your average drawdown period looks like. And that context gives you the confidence to keep executing even when things feel rough. Let me give you a real example from my own trading. There was a period last year where I went through a 2-week stretch where my cash flow targets were only hitting about 55% of the time, instead of the usual 75 to 80%. My immediate reaction was, something's off. The market changed. I need to adjust. But instead of panicking, I went back to my data. I looked at my rolling 90-day performance. And what I found was that even with that rough 2-week stretch, my overall hit rate was still sitting at 72%. I was still well within the expected range of variance for my edge. So I didn't change anything. I just kept executing. And by the end of the month, my numbers had normalized back to 77%. If I had panicked and changed my system after those 2 weeks, I would have abandoned a perfectly good edge right before it started working again. And I would have done it because I was reacting to feelings instead of data. This is the difference between traders who last and traders who blow up. The ones who last understand that drawdown is part of the game. They budget for it. They expect it. And they have objective criteria for when they'll make changes versus when they'll just stay the course. The ones who blow up are constantly chasing, constantly tweaking, and constantly reacting to short-term variance as if it's a long-term trend. So here's the framework. If your edge is statistically sound over a large sample size, trust it. If you hit a losing streak, check your data. Are you still within the expected range of variance? If yes, keep executing. If no, investigate. But don't make emotional decisions based on 3 trades. Don't abandon a system just because you had a bad week. And definitely don't go chasing the next shiny object because someone on Twitter posted a screenshot of a big win. Now let's talk about the other side of the coin. Because just like you need to know when to stay the course during drawdown, you also need to know when to press your edge when things are going well. This is something most traders completely miss. They'll have a strategy that's firing on all cylinders, hitting every target, catching extended moves, and they'll trade it the exact same way they did when they were in drawdown. Same position size, same risk per trade, same management style, and they completely miss the opportunity to maximize their winners. Here's the thing. When your edge is working at the higher end of its expected range, that's when you should be pressing. Not by taking stupid risks or over-leveraging, but by optimizing your position management to capture more of the move. For example, if I know my cash flow target hits 75% of the time on average, but over the last month it's been hitting 85% of the time, that tells me something. It tells me that the current market environment is favorable for my edge. So instead of taking the same profit at the same levels, I might let a little more run. I might scale out more slowly. I might be more aggressive about holding runners through the 3-hour sequence, but here's the key. I'm only doing this because the data supports it. I'm not getting greedy. I'm not abandoning my process. I'm just optimizing within the framework based on what the current performance is telling me. And the same logic applies in reverse. If my edge is hitting at the lower end of its expected range, let's say 65% instead of 75%, I might tighten up. I might take profit a little earlier. I might be more conservative with runners. Not because I'm scared, but because the data is telling me that the current environment is less favorable for extended moves. This is what it means to treat trading like a business. You're not just executing the same way every day, regardless of results. You're tracking performance, identifying trends and making small optimizations based on objective data. But you're never abandoning the core process. You're never making big changes based on feelings. You're just making micro adjustments within the framework based on what the numbers are telling you. And this is where the real edge compounds. Because over time, you start to develop a feel for when to press and when to pull back. Not based on intuition, but based on pattern recognition from your data. You start to notice that certain market conditions favor your edge. Certain volatility regimes make your targets easier to hit. Certain time periods give you better sequences. And the beautiful thing is, all of this is quantifiable. You can measure it. You can track it. And you can build it into your process so that you're not relying on gut feel. You're relying on historical performance data that tells you when to be aggressive and when to be conservative. But here's where most traders go wrong with this. They try to optimize too early. They'll have 20 trades of data, and they'll start making sweeping changes to their system. Oh, my edge hits better on Tuesday, so I'm only going to trade Tuesdays. No, that's not optimization. That's curve fitting to a tiny sample size. Real optimization happens over hundreds of trades. You need enough data to know that the patterns you're seeing are statistically significant and not just random noise. And until you have that data, your job is simple. Execute the process consistently and track everything. This is the boring part that nobody wants to hear. Because everyone wants the shortcut. Everyone wants to know the secret setup or the magic indicator that's going to make them profitable overnight. But there is no shortcut. The only way to build real sustainable edge is to do the work. Track your trades. Build your database. Quantify your probabilities. And then execute the same process over and over again until you have enough data to make informed optimizations. And I know some of you are thinking, this sounds like a lot of work. And you're right. It is. But here's the thing. Would you rather do the work once and build a system that prints money consistently for years? Or would you rather keep bouncing from strategy to strategy, always searching for the next thing, never building any real edge? Because that's the choice. You can either commit to the process and do the work, or you can keep gambling. And if you choose to keep gambling, that's fine, but don't lie to yourself and call it trading. Trading is a business, and businesses require work. Now let's bring this full circle, because everything I've talked about in this video, the statistical edge, the live price filters, the checkpoint targets, the sequence-based exits, the variance management, the optimization framework, all of it comes down to one simple principle. You don't need to be smart to win consistently. You just need to be willing to execute a process that's anchored to objective probabilities. And that process doesn't have to look like mine. You don't have to trade midnight open. You don't have to use the P12. You don't have to focus on the 9:30 breakout. All of that is just my specific implementation of a broader principle. Find something that happens more than it doesn't. Define clear rules for when you'll execute it and when you won't. And then follow those rules consistently regardless of how you feel. That's it. That's the whole game. But here's what makes this so difficult. It requires you to let go of the need to be impressive. It requires you to accept that most days you're just going to execute the same boring process and collect small, consistent wins. You're not going to call the top. You're not going to nail the perfect entry. You're not going to impress anyone with your chart reading skills. You're just going to show up, check if your edge is present, execute if it is, and manage the trade based on predefined checkpoints. Some days you'll make money. Yeah, some days you'll lose money. Most days you'll land somewhere in the middle. And over time, if your probabilities are sound, you'll slowly grind out consistent profit. That's not sexy. That's not exciting. But it works. And it works because it removes the human element from the equation. You're not trying to outsmart the market. You're not trying to predict the future. You're just playing a probability game with a defined edge and letting the math do its thing. And when you can embrace that, when you can let go of the ego and just focus on being a mediocre executor with good math, that's when everything changes. That's when you stop blowing up accounts. That's when you stop revenge trading. That's when you stop abandoning systems after 3 losses. Because you're not trading based on feelings anymore. You're trading based on numbers. And numbers don't care about your ego. So here's my challenge to you. Pick one setup. Just one. Something simple. Something you can quantify. Maybe it's a breakout above a certain level at a certain time. Maybe it's a retracement to a key zone during a specific session. I don't care what it is. Just pick one thing, then go back and measure it. How often does it happen? How often does it work? What's the average move when it does work? What's the average loss when it doesn't? Build a database. Get real numbers. Not guesses. Not feelings. Real quantifiable data. Then define your rules. When will you execute? When will you pass? Where will you take profit? Where will you exit if it fails? Write it all down. Make it objective. Make it repeatable. And then execute. Execute the same way every single time for at least 50 trades. Yeah, don't change anything, don't optimize, don't tweak. Just execute and track. And at the end of those 50 trades, look at your data. Are you profitable? Is your hit rate close to what you expected? Are you within the expected range of variance? If yes, keep going. Execute another 50, then another. Build your sample size. Let the probabilities play out. Make small optimizations based on objective data, not feelings. If no, investigate, figure out what's not working. Is the edge not there? Are you executing poorly? Are your rules unclear? Fix the problem and then go again. But whatever you do, don't quit after 3 losses. Don't abandon ship because you had a bad week. Don't go chasing the next shiny object. Commit to the process, do the work, and trust the math. Because at the end of the day, that's all trading is. A game of probabilities played by people who are willing to do the boring work that everyone else refuses to do. And if you can be one of those people, if you can embrace the grind, track your data, and execute consistently, you'll have something that most traders will never have: real, sustainable edge. Not because you're smarter, not because you have some secret system, but because you're willing to be average in a very specific way. You're willing to respect the numbers, follow the process, and let the probabilities do the heavy lifting. And that right there is how you become profitable without being smart. Not by having perfect entries, not by calling every move, but by building a system that removes discretion, executing it consistently, and letting the math compound over time. That's the Trader's Bible approach. That's how you turn trading from a game of chance into a game of skill. And that's how you go from being a gambler hoping for a big day to a trader running a business that prints profit consistently, month after month, year after year. So get to work. Pick your setup, build your database, define your rules, and execute. The market doesn't care about your excuses. It only rewards those who are willing to do the work. Be one of those people. And remember, you don't need to be a genius, you just need to respect the numbers and follow the process. Everything else is noise. Thanks for watching. If this shifted how you think about trading, make sure you're subscribed, because we're just getting started. Next video? Yeah, we're going to break down exactly how to build your statistical database from scratch. What to track, how to measure it, and how to turn raw data into actionable edge. You're not going to want to miss it. Until then, stay consistent, respect the probabilities, and never let anyone tell you that you need to be smart to win at this game. You don't. You just need to be willing to be boring. See you in the next one.